Welcome to today's insightful video, where we delve into the intricate mechanisms that lead to a stock market crash. In the next few minutes, we'll demystify the complex interplay of factors, from economic indicators to investor psychology, that can culminate in a market downturn of significant proportions. So, if you've ever wondered about the catalysts behind a stock market crash and the lessons we can learn from history, you're in the right place. Don't forget to like and subscribe for more investment insights. Let's jump right in and explore the anatomy of a stock market crash. Cycles are inevitable. In the realm of economics and finance, it's widely recognized that markets, including the stock market, go through cycles of expansion and contraction. These cycles are part of the natural ebb and flow of economic activity. Just as the economy experiences periods of growth, where businesses thrive and profits rise, it also encounters periods of decline, where economic activity slows down and profits decrease. These cycles are influenced by various factors such as interest rates, consumer spending, government policies, and global economic conditions. Within these larger economic cycles, the stock market experiences its own series of ups and downs. This includes periods of rapid growth, often referred to as bull markets, where stock prices rise steadily, and investors feel optimistic about the future. Conversely, there are also times of contraction, commonly known as bear markets, characterized by falling stock prices and a sense of pessimism in the market. Stock market crashes are extreme instances of these bear markets, marked by sudden and severe drops in stock prices over a relatively short period. They can be triggered by a variety of factors, such as economic recessions, financial crises, geopolitical events, or even unexpected developments within specific industries. These crashes can lead to significant financial losses for investors and can also have broader impacts on the economy. Robert Kiyosaki's point about cycles being inevitable underscores the notion that market fluctuations are a natural part of the financial landscape. Understanding that these cycles occur can help investors avoid panic during downturns and make more informed decisions about their investment strategies. While market crashes can be unsettling, they are not unexpected, and historically, markets have eventually recovered and resumed their upward trajectory as the economy rebounds from the contraction phase of the cycle. Opportunities in crisis. Robert Kiyosaki often emphasizes the idea that challenging times, such as market crashes, can present unique opportunities for savvy investors. Here's a more in-depth look at this concept. Market crashes, while causing financial distress for many investors, also create a situation where asset prices are significantly lower than their intrinsic or long-term value. This is often due to panic selling and negative market sentiment. Kiyosaki's perspective is that during these periods of market turmoil, there's a chance to acquire valuable assets at a lower cost, effectively buying when prices are on sale. Kiyosaki's philosophy aligns with the classic investment adage of buy low, sell high. When the market crashes and prices are low, investors who have done their homework and have a clear understanding of the assets they're investing in can identify those that are fundamentally strong but temporarily undervalued due to market sentiment. By purchasing such assets during a market crash, investors position themselves to potentially benefit when market sentiment improves and prices begin to recover. As the market rebounds and economic conditions stabilize, the value of these assets can appreciate, potentially generating substantial returns over the long term. However, Kiyosaki also emphasizes the importance of careful analysis and due diligence. Not every asset that experiences a price drop during a market crash will necessarily rebound strongly. It's crucial to assess the fundamental health of the asset, the industry it belongs to, and the broader economic factors at play. Kiyosaki's message is about having the financial education and mindset to recognize these opportunities and the willingness to act on them when others might be fearful. This approach, often referred to as contrarian investing, involves going against the prevailing market sentiment to make investments that have the potential to provide strong returns in the future. It's important to note that while there can be opportunities during market crashes, investing during such times also carries risks. Markets can remain volatile for extended periods, and not all investments will recover as expected. Diversification, proper research, and a long-term investment perspective are key considerations when implementing this strategy. If you found this video helpful, don't forget to like and subscribe for more investment insights. And remember, before making any investment decisions, do your own research or consult a financial advisor. Diversification. Robert Kiyosaki frequently emphasizes the importance of diversification as a risk management strategy within an investment portfolio. Here's a deeper exploration of this concept. Diversification defined. Diversification involves spreading your investments across different types of assets and industries to reduce the impact of a potential loss in any single investment. The idea is to avoid putting all your financial eggs in one basket. By diversifying, you aim to lower the overall risk in your portfolio, as the poor performance of one investment may be offset by the better performance of another. Kiyosaki's perspective. Kiyosaki's financial teachings often advocate for a diversified approach to investing. He suggests that having a mix of assets, such as stocks, real estate, bonds, precious metals, and potentially other investments, can help mitigate the potential negative effects of a market crash or economic downturn. Risk mitigation. Diversification is rooted in the principle that different types of investments may react differently to market events. For example, during a stock market crash, while stock prices may plummet, the value of other assets like bonds or certain commodities may be less affected or could even rise due to investors seeking safer havens. Sector and industry spread. Kiyosaki's diversification philosophy extends beyond just asset classes. He also emphasizes diversification within industries and sectors. This means that even within the stock market, investors should spread their investments across different industries, like technology, healthcare, finance, etc., to avoid overexposure to the potential downturn in a single sector. Long-term focus. Kiyosaki's approach to diversification is often aligned with his broader emphasis on investing for the long term. While diversification can help cushion the impact of short-term market fluctuations, its true benefits are often realized over time as the various assets in the portfolio respond differently to changing economic conditions. Cautions and considerations. While diversification is a widely recognized strategy, it's important to note that it doesn't eliminate all investment risks. It can help reduce the impact of a single investment's poor performance, but it won't prevent losses entirely. Moreover, over-diversification, owning too many investments, can dilute potential gains. Careful research and consideration of each investment's fundamentals are still essential. Kiyosaki's point about diversification underscores the importance of spreading investments across a range of assets and industries to manage risk and navigate market volatility. It's a strategy aimed at providing a more balanced and resilient portfolio that can weather the challenges of economic cycles and market fluctuations. Focus on cash flow. Robert Kiyosaki frequently advocates for generating passive income and positive cash flow as a key financial strategy. Here's a more comprehensive exploration of this concept. Cash flow defined. Cash flow refers to the movement of money into and out of your financial accounts. Positive cash flow occurs when your income exceeds your expenses, resulting in surplus funds. Negative cash flow, on the other hand, means your expenses are higher than your income, leading to a deficit. Kiyosaki's perspective. Kiyosaki's financial teachings emphasize the importance of focusing on investments that generate consistent positive cash flow. This means that the investments you choose should produce regular income, even if market conditions are fluctuating. Passive income. Kiyosaki's preference for cash flow aligns with the concept of passive income. Passive income is money earned with little to no ongoing effort or active participation on the investor's part. Examples include rental income from real estate properties, dividends from stocks, and royalties from intellectual property. Resilience during market crashes. By emphasizing cash flow, Kiyosaki's approach aims to provide a financial cushion during market crashes or economic downturns. Investments that generate positive cash flow can continue to provide income even if asset values temporarily decline. This can help investors cover their living expenses, service debts, and maintain their financial stability during challenging times. Real estate as an example. Kiyosaki often uses real estate as an example to illustrate his focus on cash flow. He suggests that investing in rental properties can be a way to achieve steady rental income, which contributes to positive cash flow. While property values may fluctuate with the real estate market, the rental income remains relatively stable and can provide ongoing financial support. Mindset shift. Kiyosaki's emphasis on cash flow represents a mindset shift from simply seeking capital gains, profits from selling assets at a higher price, to valuing consistent income generation. This approach aligns with his broader message of achieving financial independence and the freedom to make choices without being solely dependent on a traditional job. Considerations. While positive cash flow is a valuable strategy, it's important to note that achieving consistent cash flow often requires careful investment selection, property management, and ongoing monitoring. Not all investments will automatically provide positive cash flow, and each investment requires thorough analysis to ensure its potential to generate income over time. Kiyosaki's point about focusing on cash flow underscores the importance of investing in assets that generate regular income, even during market downturns. This approach is aimed at creating financial stability and independence by prioritizing consistent passive income alongside potential capital gains. Value investing. Robert Kiyosaki often supports the concept of value investing as a prudent approach to selecting investments. Here's a deeper exploration of this principle. Value investing defined. Value investing is an investment strategy that involves searching for stocks or assets that are trading at prices lower than their intrinsic value. Intrinsic value refers to what an asset is actually worth based on its fundamental characteristics, such as earnings, cash flow, assets, and growth potential. Kiyosaki's perspective. Kiyosaki's financial teachings emphasize the value investing approach, which aligns with his philosophy of making informed investment decisions based on a thorough understanding of an asset's worth. Fundamental analysis. Value investing often involves conducting detailed fundamental analysis of an investment. This includes evaluating financial statements, studying industry trends, assessing competitive advantages, and understanding the overall health of the company or asset. The goal is to identify assets that are temporarily undervalued due to market sentiment or other short-term factors. Long-term view. Kiyosaki's approach to value investing encourages investors to take a long-term perspective. Rather than being swayed by short-term market fluctuations, value investors focus on the underlying fundamentals that determine an asset's true value. This aligns with Kiyosaki's broader message of investing for financial security and independence over the long haul. Contrarian approach. Value investing often involves a contrarian mindset. When the market is exuberant and prices are high, value investors look for opportunities in overlooked or undervalued assets. By going against the prevailing market sentiment, investors can potentially find assets that have strong potential for growth once their true value is recognized by the market. Risk management. Value investing incorporates an element of risk management. By investing in assets with a perceived margin of safety, the difference between the market price and the estimated intrinsic value, investors aim to reduce the potential downside risk if the market experiences a downturn.